Hey guys, in today's video we'll be doing something interesting. We will be taking a set of transactions for a company and then we'll record the journal entries both under cash accounting and under accrual accounting method. And you're gonna want to stick around till the end because what we'll do at the end is take the general ledger and then prepare an income statement both under cash accounting and under accrual accounting so they can see clearly the difference on the gross profit under both methods. So if that sounds good to you, let's dive right in. Welcome to another video with your favorite financial controller, Bill Hanna. Today's video is meant to show the impact of the accounting method that you choose on the economics of the income statement. The two accounting methods being the cash accounting and accrual accounting. Cash accounting is used by small businesses, typically at the beginning of the business. So when you have a startup, typically at the beginning below $1 million in revenue, you're using the cash accounting because it's easy and because when you look at the income statement, it tells you pretty much the cash that's coming in and the cash that's going out. Once you begin to get more investors, get loans from banks, and have more stakeholders in the business, you need to use the accrual accounting method because that is the accounting method that is recognized under US GAAP and under IFRS. So let's dive in and see what kind of business we have and the type of business transactions we're talking about. Make Me Famous Marketing LLC. The company provides social media marketing services and hires subcontractors to perform the work. Okay, the business engaged in these activities. The first transaction that we have here is that the company sells $10,000 worth of marketing services performed on December 24th, 2024. The company issues the client an invoice and the client pays on January 20th of 2025, so in the next year. Okay, so under the cash accounting method, in 2024, what would be the impact under the cash accounting method? Well, there will be no impact because the cash only got collected in the next year, in 2025. So when we look in 2025, under the cash accounting method, we will have a debit to cash for $10,000 and credit to revenue for $10,000. Placing revenue in 2025, which is, we'll see economically is incorrect because the revenue was performed in the year before that in 2024. Now let's look at accrual accounting and how accrual accounting is going to handle the same transaction. Under accrual accounting, what we'll say is, well, we performed the service in 2024, therefore economically, revenue should be recognized in 2024. So we'll issue an invoice that will create a debit to accounts receivable for $10,000 and credit revenue for $10,000, recording revenue in the correct period. In 2025, what we're gonna have is gonna be purely a cash movement. Cash coming in for $10,000, debiting cash, and credit to accounts receivable to remove accounts receivable from the books for $10,000. So you can see from these two ways of recording it that the cash accounting method is easily showing the cash that's coming in on the books. So if you're the business owner, you can see that the cash is coming in 2025. So if you only care about cash and how it looks on your financials, you would use the cash accounting method because you can easily see where the cash came in 2025. However, under accrual accounting, we care about the fairness and the presentation economically, right? So we want to show revenue where it was performed. It was performed in 2024. Therefore, the revenue gets recorded in 2024. Let's look at another example. The second transaction that we have is a cost transaction. So it says the company pays a subcontractor for their services in December 2024. That's $5,000. The payment is made to the subcontractor on December 29th, 2024. We're paying $5,000 in 2024 for services performed in December 2024, which sounds like the cash is matching the economic value of the service. So the service here is performed in 2024. So under cash accounting, we will say debit labor cost, which is an expense account, and credit to cash, right? Because cash is spent in 2024. We have nothing to do here in 2025 since the transaction is all in 2024. Under accrual accounting, when we look at the treatment, it's going to be a very similar treatment because the economics of this transaction all happened in 2024. Therefore, we do the same thing. We credit cash $5,000 and debit labor costs for $5,000. All right, great. Let's move to transaction number 3, which is another revenue transaction. The company receives $12,000 in December 2024. The payment is for marketing services the company will perform in January 2025. So this is $12,000 we're receiving in advance of performing the actual service in the following year. Under the cash accounting method, let's have a look here. So for cash accounting, because we are following the cash, we're receiving $12,000 in 2024. So we'll say debit cash $12,000 and credit revenue for $12,000, right? Which is, from a GAAP perspective or US GAAP perspective, this is not the correct treatment because the revenue should follow when the service is being performed, which is in 2025. Under accrual accounting, the correct treatment for this is that in 2024, we will be recording a debit to cash for receiving $12,000 and credit to deferred revenue for $12,000, which is a liability. So we're recording a liability on the books for $12,000, saying this revenue is unearned. We're recording it to deferred, we call it deferred revenue or unearned revenue, and that's going to stay as a liability until 2025 comes around. And let's see what we'll do here. We will debit deferred revenue for $12,000, removing that from our books, and credit revenue for $12,000, saying, hey, we performed the service now in 2025, and it's time to record that revenue on our books. This template, by the way, is going to be available down below in the description. Go ahead and download it so you can practice for yourself how to record the various transactions under cash and accrual accounting. Let's move on to transaction number 4. But before discussing that, if you're learning and gaining knowledge from this video, do me a favor and hit the like button. And if you haven't subscribed to the channel, go ahead and subscribe because that's the way you can help me out, and it's completely free to you by subscribing and liking this video. Okay, transaction number 4. One of the subcontractors asks for an advance payment of $5,000 in December 2024. The advance payment is for work he will perform in January of 2025. Okay, let's go ahead and see under cash accounting. What we're going to be recording here, since we're following the cash, is in 2024, we will credit cash clearly because that's when we spent it, and we will debit labor cost for $5,000. So we recorded a cost for the labor in 2024, which is economically incorrect because the service will be performed by the subcontractor in the next year. Right, but this is cash accounting. It oversimplifies everything by looking at when the cash is moving. Let's look at accrual accounting and how it's going to treat this prepayment on the books. Accrual accounting is a concept that is discussed in length and techniques are taught in the Controller Academy. So go ahead and check that out. All right, so for this transaction under accrual accounting, let's have a look. In 2024, we will be recording a credit to cash, which makes sense. That's the same in both a cash and accrual accounting. Cash is leaving the bank, so it's a credit to cash. However, what we will debit is going to be prepaid cost because you are prepaying this for a cost that will happen in the future. The service itself will be performed in the future by this subcontractor. So you debit prepaid cost, and when 2025 comes around, you will be then crediting the prepaid cost to remove it from your books and recognizing the actual cost on the P&L, which is debit to labor cost for $5,000. All right, so now that we discussed how to record the various transactions under cash and accrual accounting, I want to move along and prepare the income statement under both methods of accounting. Before doing that though, I would love to hear from you in the comment section below whether you're using cash or accrual accounting right now. That gives me a gauge into which method is being used the most. When we go ahead and record the income statement for cash accounting, so we have the income statement for 2024 and 2025. Under cash accounting in 2024, what we'll have is for the first revenue transaction, there will be no impact on the income statement because if you remember, in the first transaction, we only recognize the revenue when the cash is received in the subsequent year. We record $12,000 from transaction number 3 of revenue coming in right here, which is also economically incorrect because that was a prepayment of revenue. So that's deferred revenue, or we call it unearned revenue, but under cash accounting, we still recorded that in this year. For the cost transaction number 2, $5,000. We recorded that because we spent the cash. And then for cost transaction number 4, we recorded $5,000 because the labor cost was paid in 2024, yielding a gross profit in 2024 of $2,000. When it comes to 2025, we recorded 10 grand for revenue for the first transaction because the cash came in 2025. Again, economically incorrect because the cash came in 2025, but the revenue was earned in 2024. But because we're following the cash, we recorded it this way. No impact on the income statement for the following 3 transactions under the cash accounting method because there was no cash being spent in 2025 for these transactions. It all got recorded in 2024. So you can see that under the cash accounting method, gross profit was $2,000 in 2024 and $10,000 in 2025. Let's move over to the accrual accounting method and see how it got recorded in both years. In 2024, under accrual accounting, the first transaction called for $10,000 being recorded as revenue. If you remember, in the cash accounting, we recorded 0 from transaction number 1 in 2024, but now we correctly recorded in 2024 under revenue. The second transaction, we captured $12,000 in cash accounting. However, here we correctly say this revenue doesn't belong in 2024, but rather if we look at 2025, we'll see that it gets recorded in 2025. For the first cost transaction, we're recording here correctly under accrual accounting, $5,000. Because we're saying here that the $5,000 belongs to 2024, which is the same treatment, by the way. This is the only transaction that has the same treatment under cash and accrual accounting, and that goes right here. For the final transaction, which is a cost transaction, under the accrual accounting method, we record the $5,000 in 2025 correctly. And you can see that for both the cash and accrual accounting, the gross profit is different in both years. It's $2,000 in 2024 and $10,000 in 2025. But then under accrual accounting, there is different distribution of gross profit because that represents the economic value of the transaction. And that is why it is the method that is accepted by investors, banks, and stakeholders who want to see the actual economics of the business and not just the simple cash movement. Because for that, we have the cash flow statement, and that's how we can track cash. But for the income statement, the accrual method is the correct way to go. Thank you so much for watching, and I'll see you in the next video.